Are you ready to take control of your finances and invest wisely? Investing can be a daunting task, but with the right knowledge and strategies, it can be a rewarding experience. One of the most important aspects of investing is creating a balanced investment portfolio. But what exactly does that mean and why is it so important? In this video, we'll explore the world of balanced investment portfolios and how you can make the most out of your investments. So sit back, grab a pen and paper, and let's get started. A balanced investment portfolio is one that is diversified across different asset classes such as stocks, bonds, and cash, and is designed to achieve a specific level of risk and return. It's important to have a balanced investment portfolio because it can help you reduce risk while maximizing returns. By spreading your investments across different asset classes, you can protect your portfolio against market fluctuations and reduce the impact of any one investment on your overall returns. Diversification is one of the most important concepts in investing. By diversifying your portfolio, you can reduce risk by spreading your investments across different asset classes, industries, and geographies. This means that if one asset class or sector is underperforming, your entire portfolio won't be affected as severely. Diversification also allows you to take advantage of different market conditions, as different asset classes tend to perform well at different times. The risk-return trade-off is a fundamental concept in investing. Generally speaking, the higher the risk you take, the higher the potential return. However, this also means that you're more likely to experience losses. Conversely, if you invest in lower-risk assets, your potential returns will be lower. As an investor, it's important to strike a balance between risk and return that aligns with your investment goals and risk tolerance. Determining the appropriate asset allocation for your investment portfolio involves assessing your investment goals, risk tolerance, and time horizon. Generally, younger investors with a longer time horizon can afford to take on more risk and invest in more volatile assets such as stocks. Older investors with a shorter time horizon may prefer to invest in more stable assets such as bonds. By working with a financial advisor or using online tools, you can determine the appropriate asset allocation for your investment portfolio. One example of an unbalanced portfolio is an investor who puts all of their money into a single stock. If that stock performs poorly, the investor could experience significant losses. Another example is an investor who doesn't diversify across different asset classes. If the stock market crashes, their entire portfolio could be wiped out. By diversifying across different asset classes, you can protect your portfolio against these types of losses. Rebalancing your investment portfolio involves periodically adjusting your asset allocation to maintain your desired level of risk and return. If one asset class has performed particularly well, you may need to sell some of those assets and invest in underperforming asset classes to maintain your desired allocation. By rebalancing your portfolio regularly, you can ensure that it remains balanced and aligned with your investment goals. Achieving a balanced investment portfolio is a journey that requires patience, knowledge, and discipline. However, even the most experienced investors make mistakes that can derail their financial goals. Let's take a look at some common mistakes that investors make when trying to achieve a balanced portfolio and how they can be avoided. Mistake 1: focusing too much on past performance. It's common for investors to be attracted to investments that have had good performance in the past. However, past performance doesn't guarantee future results. Instead, investors should focus on the long-term prospects of an investment and consider factors such as the company's financial health, management team, and industry trends. Mistake 2: failing to diversify. Diversification is key to managing risk and achieving a balanced portfolio. However, many investors make the mistake of investing all their money in a single asset class or industry. To avoid this mistake, investors should consider diversifying across different asset classes, such as stocks, bonds, and real estate, and within each asset class. Mistake 3: overreacting to market volatility. Market volatility can be unsettling, and it's tempting to react emotionally and make impulsive decisions. However, this can lead to buying high and selling low, which is the opposite of what investors should be doing. To avoid this mistake, investors should have a long-term investment plan and stick to it, regardless of short-term market fluctuations. Mistake 4: Not rebalancing regularly. As we discussed earlier, maintaining a balanced portfolio requires regular rebalancing. However, many investors neglect this important step, which can lead to an unbalanced portfolio over time. To avoid this mistake, investors should set a regular schedule for rebalancing and stick to it. By avoiding these common mistakes, investors can improve their chances of achieving a balanced investment portfolio and reaching their financial goals. In conclusion, having a balanced investment portfolio is essential for achieving long-term financial goals. Diversification across different asset classes can reduce risk and increase potential returns. The risk-return trade-off should also be considered when making investment decisions. Determining the appropriate asset allocation for your portfolio requires careful consideration of personal goals, risk tolerance, and time horizon. Avoiding common mistakes such as overreacting to market fluctuations and not diversifying enough can help investors achieve their financial goals. Don't miss out on the opportunity to build a balanced investment portfolio that can help you achieve your financial goals. Subscribe to our channel and hit the notification bell to get notified of our upcoming videos on investing. And if you have any questions or comments, leave them in the comments section below. Let's start building your investment portfolio today.